Thanks very much, Peter. Income-focused investments play a big role in portfolios for Australian investors. Given global interest rates are now at all-time lows and with a macroeconomic backdrop of COVID-19 uncertainty, investors are actively searching for alternative investments to achieve consistent, reliable, and diversified sources of income. I'm Yin Peng Chiew, Director of Strategy at Qualitas. I am responsible for fund strategy and investor relations for the Qualitas Real Estate Income Fund, that is QRI, a pure-play commercial real estate debt fund listed on the ASX. I'm very pleased to introduce you to the commercial real estate debt asset class, or CRE debt for short, and also to present the QRI opportunity, an alternative investment which aims to achieve attractive, regular income whilst preserving capital. Private debt is the provision of lending by non-bank or alternative lenders, and their contribution to the global credit market is significant, representing almost 50% market share. Alternative lenders also provide private CRE debt, which is the provision of loans to finance real estate, both for investment and development purposes, to wholesale borrowers. The $380 billion CRE debt market can provide some attractive risk-adjusted returns, and investors can access this opportunity through QRI, which is designed for investors looking for regular monthly income, capital preservation, and portfolio diversification. QRI benefits from the investment management expertise of Qualitas, one of Australia's leading real estate investment managers specialised in investing across the entire capital structure of real estate, debt, and equity. Qualitas was established in 2018 during the GFC, where banks were pulling back their CRE lending and alternative lenders backed by growing investor capital identified a unique opportunity to fill the funding gap. We have built up an extensive track record, and in our 13 years of our operation, we have invested $4.6 billion of investor capital for real estate assets valued over $12.6 billion. We have closed more than 200 investments and incurred zero losses of investor capital, which is testament to our disciplined investing. CRE debt is an asset class that offers compelling benefits for those seeking income. CRE debt seeks to generate monthly income by providing loans to commercial borrowers who require funding for real estate purposes. The income stream is predictable because the loan interest and fees are agreed upfront, so this fixed income is known for the duration of the loan. Here we show the investment universe for income, which ranges in risk and return. And as you can see from the chart, private CRE debt can deliver some attractive risk-adjusted returns compared to other investments, especially when compared to equities and traditional property, which are higher up on the risk curve. CRE debt is predominantly provided by banks. However, there is part of the market that is provided by non-banks or alternative lenders, which is referred to as private CRE debt. And this is where the specific alternative income investment opportunity lies. When looking at the capital structure and a wind-up of the company or sales of assets, secured debt is always repaid first, followed by unsecured debt, subordinated debt, hybrids, and lastly, equity. The key feature of CRE debt is it is classified as secured, the highest priority in the capital structure. So these investors always get their capital repaid first. So what is the CRE debt opportunity for alternative lenders? We estimate the Australian CRE debt market at $300 billion, where banks dominate, making up 93% of all CRE lending. The remainder 7% of the market is provided by alternative lenders, a sector that, while small at $25 billion, is well established and has been growing steadily, becoming more sophisticated in funding solutions for borrowers over time. Year on year, the CRE debt market grows by between 2 to 4% per annum, driven by population growth and urban expansion. And since the GFC and in the current economic climate, banks have been withdrawing from the lending market, leading to a growing shortage of debt capital for borrowers over time and better opportunities for alternative lenders such as Qualitas. The structural and permanent shift in bank lending has been as a result of increased APRA regulation and government oversight. And alternative lenders continue to gain market share as not only to fill the funding gap left by banks, but due to increasing borrower demand for flexible financing, of which borrowers are willing to pay a premium for. Comparatively, if we look at the more established and sophisticated US and European markets, alternative lenders hold between 45 and 50% market share, which not only demonstrates the importance and the permanence of alternative lending in the global financial system, but the potential for further growth in the Australian CRE debt market. Over the last decade, the Australian economy has been relatively sound compared to other countries, with uninterrupted GDP growth and good population growth. And it is expected that post-COVID-19, these fundamentals will return to the market. So what is the current conditions and outlook of the CRE debt market? Well, despite a macroeconomic backdrop of COVID-19 continuing to impact various parts of the country, Australia has generally demonstrated a level of economic resilience as supported by the government. We are seeing no major distress in the CRE debt market, and generally these conditions in Australia are more favourable than offshore markets, which has led to increased investment activity, both from domestic and offshore alternative lenders in recent months. Loan pricing has started to compress due to increased competition. However, we as a manager remain disciplined with our investment selection and will not compromise on transactions which present material credit risk, ensuring strong sponsor and property quality. A very low interest rate environment supports cheaper borrowings, increases borrower demand for loans, and in turn, positive property yields and valuations. Qualitas is well positioned in the Australian market due to our long-standing local presence and deep borrower relationships built on trust and repeat lending over many years. Qualitas is a through-the-cycle investor, and we are sector agnostic and always seek to invest in the best risk-adjusted return opportunities, having regard to the timing within the cycle of the market. We're very comfortable navigating the diverse sector opportunities presented in the market as guided by our sector outlook here, which identifies which sectors are performing, which sectors are neutral or subject to increased risk. The CRE debt asset class is highly resilient in times of volatility, given its unique capital preservation characteristics, whilst offering attractive risk-adjusted returns. The highly regulated ADI CRE debt book now has one of the lowest impairment rates of less than 1% compared to other asset classes, with no increase during COVID last year. From what we have observed in the private CRE debt market, there is no major distress, and we have not suffered any impairments or losses on the QRI loan portfolio. We expect that impairment rates for alternative lenders are likely at similar levels to the ADIs, although this depends both on the experience of the lender and the quality of the sponsor, as private CRE debt is highly specialised and does require the skill of a specialised manager. In our view, the resilience of the CRE debt asset class was proven up during COVID-19 through QRI's stable performance, both in premium returns, achieving around 6% per annum, and a stable NAV due to no impairments, which we'll go into further detail later. In terms of asset class allocation for investment portfolios, we believe that CRE debt is unique in that it can fit into three asset classes, being fixed income, property, and alternatives. Diversification across the capital structure is also important to diversify risk. Hence, an allocation to debt may be suitable for investors looking for less capital volatility than investing in equities. Whilst the determination of asset class allocation is based on individual profiles, CRE debt provides additional diversification regardless. In summary, CRE debt is a good, defensive, and income-focused asset to hold alongside other income-generating asset classes, typically found in investor portfolios. I will now take you through the QRI opportunity. Having successfully established a wholesale real estate debt fund platform, we felt that 2018 was the right timing to further diversify our investor base and bring a similar CRE debt offering to the retail market in a listed and liquid form. We are very proud to have launched QRI as the first income-focused, pure-play CRE debt fund listed on the ASX during a time when investors were increasingly seeking alternative income sources at attractive risk-adjusted returns. QRI has a simple credit strategy, investing only in CRE loans to well-established Australian commercial property investors and developers, which are all secured by real property mortgages and are distinct from equities, bonds, and corporate loans. QRI pays monthly cash distributions targeting a return of RBA cash plus a margin of 5 to 6.5%. As of 31 July 2021, QRI met all its investment objectives and delivered a distribution return of 6.09% per annum, which demonstrates excellent risk-adjusted returns for our investors. The QRI portfolio comprised of a well-diversified portfolio of 32 loans, which are predominantly senior first mortgage, And QRI's performance during COVID-19 was pretty solid. We had no impairments recorded in the portfolio, resulting in a stable NAV, which has been the case since the IPO. And importantly, there has been no deterioration in returns. QRI's unit price, however, was impacted by COVID-19 in 2020, despite no impairments experienced in the underlying portfolio or deterioration in returns, as mentioned before. And this created a dislocation in the unit price to actual asset values. As a result of the manager's direct efforts to support the unit price and improve secondary demand, coupled with investors returning confidence, the unit price did return back to par trading in February of 2021 this year. We have demonstrated that over the past 12 months that we are able to support the unit price in times of volatility, and its current premium trading is a testament to QRI's strong and stable performance and the resilience of the CRE debt asset class. Importantly, as an experienced CRE debt manager, we instill discipline in appropriately pricing our loans commensurate to the risk taken for the current market opportunities and in line with market pricing. We will never go up the risk curve for the sake of achieving excess returns. We take an active management approach to the QRI loan portfolio from our in-house origination, undertaking rigorous investment due diligence to select best loans and conducting ongoing individual loan reviews on a monthly basis. We know all of our borrowers individually, and the loans are of very high quality. 91% of the loans are first mortgage and 9% are second mortgages. 98% have the benefit of a personal guarantee. We lend across the life cycle of real estate, as represented by the diversification of loan types, investment loans, construction loans, and land loans. We have a high exposure to the residential sector, naturally due to property developers having the highest borrower demand for alternative lending. However, in recent times, there has been compelling opportunities for residual stock loans. Over time, we expect our residential exposure to naturally amortise over the next 6-12 months as the residual loans are progressively repaid. The portfolio is also 100% invested in Australian CRE debt, with 94% invested in our Qualitas core markets of Melbourne, Sydney, and Brisbane. One of our current investments includes a $35 million senior investment loan to finance a B-grade Melbourne CBD office property, tenanted by an A-grade tenant, and the borrower being a private high net worth investor. So why should you invest in QRI? Well, our investors have continued to invest in QRI for the following reasons. Firstly, QRI provides regular and stable monthly income at attractive risk-adjusted returns in a low interest rate environment. It provides excellent capital preservation characteristics as all loans are secured by real property mortgages. Importantly, QRI has a simple and focused credit investment strategy, easily understood compared to other investments, and also provides further portfolio diversification. Access to an experienced CRE debt specialist, of which Qualitas has an alignment of interest with investors through its $10 million investment in QRI. And lastly, CRE debt provides the benefit of exposure to the property market without the equity risk of direct property investing. In summary, I leave you with our key takeaways for this presentation. As a leading real estate investment manager with extensive track record, we are committed to educating our investors in CRE debt, a highly specialised asset class. QRI's risk-adjusted returns are very attractive in this low interest rate environment, provides capital preservation in times of volatility, whilst also achieves portfolio diversification. QRI's performance has been strong with consistent returns delivered, no impairments on the portfolio since the IPO or during COVID-19, and currently trades at a premium to its net asset value. Thank you for your time.